Welcome back, my awesome people. Today, I am honored to be sitting here with Eli Michael. Now, he is the CEO of Clockwise Capital. And if you are a big fan of my channel, you know we've had Clockwise Capital on the channel way before, about a year or so ago. And I'm so happy to be sitting here with the CEO. Now, in this interview, we're going to be talking about a unique research piece called When Clocks Align. And for those that don't know, this is new to me. I'll be learning at the same time, but it actually discusses the six independent macro frameworks, which are built decades apart by researchers who never collaborated, but they had the same instinct, the same mentality, all converging in the same 2027 to 2029 window. So if you don't know what I just said, please stay tuned because this is actually such a unique interview. Also, Clockwise Capital has built a unique AI called Kronos. So, for those of you, my AI techies, those of you who love information and data, this will be a great interview for you. So, let's just get right into it. Eli, how are you doing today?
I'm doing well, Jacob. Yeah, thanks so much for having us. As mentioned before the show started, we are big fans of the show. James really enjoyed his time on here, so we said we got to get back on Jacob's Rant. So thanks so much for having us.
I'm glad that James had a good time, and I'm sure you will have an awesome time as well. So let's just get right into it. So Eli, let's start at the beginning. What drew you into the world of finance, investing, and how did you get involved with Clockwise Capital?
Yeah, so my background, I come from a family that does not invest or did not invest. They do invest now. But our community in general, oftentimes was left out of these conversations about investing education, and really about access to information and tools in order to implement it. And so what drove me into the world of finance in 2007, wow, 19 years ago now, was really that thought and that idea that I wanted to bring more access and more tools to communities that look like ours. And more broadly speaking, recognizing that access to information and the tool sets available to people were going to become more ubiquitous. And we really wanted to be the frontline leaders of that. So Clockwise started in 2017. I founded it by merging with another practice. We put together a suite of offering of portfolios that we managed for individual investors. And our company really has morphed into much more of a financial tech or fintech company, really leading with AI and leading with technology that has a real goal of educating, informing, and creating the access that we set out to create, and to be able to put ourselves in a position where we offered a tool set to investors that allowed them to implement what we think is going to be a future that they can't miss out on, but a past that we cannot also avoid. And so that's what we wrote in When Clocks Align that you just laid out. And that's really what we hope to deliver on with respect to Kronos AI.
I actually love that reason of why you got into this because not only is it our community, but even just, the generation where money was to be saved and not invested. That's kind of why I kind of started this channel as well, is to kind of show people that you can do it. Investing is not complex, it's not a scary subject, and it's making money while you kind of sleep, right? And so let's talk more about when clocks aligning, the research that is done. Can you describe the core idea and what does it actually mean in the financial context?
Sure. So the core idea of When Clocks Align is all about the idea that, as you mentioned, we have six independent researchers that we were able to uncover, really discovering the same sort of time window. And what that time window is it really focuses on what we see as being sort of the biggest problem in the market, which is how do we deal with a U.S. government and a debt problem of 125% of GDP, paying $1 trillion in interest. And how does that debt cycle impact growth over the long term and investors' ability to take advantage of growth, specifically within tech? And so, When Clocks Align is really about these different individuals who, as mentioned, never collaborated, and really start off in really different time periods. So I'll sort of take you through it, Jacob, and sort of lay out those six economists slash practitioners that we see in the market.
Yes,
So
please.
we sort of start the journey off in the 1920s with Nikolai Kondratiev, and he's got a really interesting story. Basically, he was an economist that grew up in rural Russia under a communist regime, really putting himself in a position where he wanted to study markets and how markets develop, and really the state of capitalism juxtaposed against socialism, which was what he was a part of. And what he realized is that capitalism is really a complex adaptive system, and that it does not destroy itself. However, it does go through these cycles, these cycles of creation that happen about every 50 years. And so what he landed on was that complex adaptive systems renew themselves, and capitalism will do the same. Unfortunately, he paid a heavy price for that. He was jailed for about 5 to 8 years, I believe it was, and ultimately was killed by gunfire. But his legacy remains on, and what his cycles predict, and the format that he lays out with respect to said cycles predict a window. And we'll get into what that window looks like. But the next practitioner that we really studied with respect to, okay, if capitalism is a complex adaptive system, why is that? And then we get into really William Strauss, and Neil Howe, who really discovered that the reason behind capitalism as a complex adaptive system has to do with the humans that are part of this system, and really the sort of immutability of those humans across space and time. Humans don't really change all that much. And so what Strauss Howe did is they identified that humans go through these four cycles and that they're tied to generations. And the reason why cycles repeat is because the generation that remembers what happened during the previous cycle effectively dies off and takes those memories with them. And so they lay out the cycles for generations for why these capitalistic systems go through this process, and they land on the same window. And we'll get into that window again. The next we get into is Ray Dalio, who I'm sure your listeners are well aware of. He talks about these five forces. He talks about the internal disorder, the external disorder, the debt cycle, environments, and technology. And so those are kind of the forces that are driving that human behavior. They point to the same window. Then we looked at sort of what is the sort of catalyst that breaks the camel's back with respect to the cycle, and that is your Hyman Minsky, who did a lot of work in the 70s that talked about how different debt cycles form and ultimately how debt cycles and bubbles burst. And the long and short of it is that they burst when you get into something called hedge financing, which really has to do with the government or an entity not being able to repay the interest on its debt. And what it has to do in order to repay that interest is it has to borrow money in order to pay the interest itself. So that cycle can only continue but for so long. His work points to a specific window. The last two have to do with Carlota Perez, who she lays out a framework for the technology cycle. Again, 4 stages. Irony around four it seems to be a recurring pattern. But Carlota Perez basically talks about how technology cycles work from frenzy to eruption, sorry, from eruption to frenzy to turning point, right on to a golden age. And so what it appears as though is that we're in somewhat of a transition period from the frenzy stage to the turning point. And really what that means is that the crescendo from that is that we have a debt problem that technology and growth cannot solve. And so there's some structural limitations, but her cycle points to the same window. Lastly, we get to Clockwise Capital, and the cycle that we've developed internally is based off of the work primarily of a gentleman named Richard Foster. And Richard Foster basically pointed to the life cycles of companies, and pointed out and identified that the life cycles of companies is also shrinking, going from about 40 years or so in the 1960s. I'm sorry, about 61 years or so in the 1960s to about 18 years now. The average life cycle of a company within the S&P 500. So if you take those six practitioners, you put them together, they land on the same window. And that window has to do with 2027 to 2029. And effectively, what they say within that window is that the math dictates that we need to go through a reset. And that reset is basically pointed out in When Clocks Align with respect to four different possibilities. But the point is that every single one of those possibilities has to do with a combination of market correction and and inflation, devaluation of the dollar. So the problem is the debt. The solution is growth, but we're going to have to go through some pain before we get to the other side.
Eli, thank you. That was an amazing, detailed way of explaining the frameworks because I love history. I've been studying history. I'm a major in history, and you're absolutely correct. Humans, history has a pattern. We go through cycles. For many millennia, we've been going through cycles. And Ray Dalio, the legend, I loved his book, The Changing World Order, where he's talking about not only the changing of a superpower, but also the dollar, the currency, and how that impacts. And there has been a lot of talk in the past few years, not even maybe in the past year, especially about, the US dollar, coming off of the being the world reserve, and we might go into something new. And I know a lot of people are talking about digital currency, digital assets, but it's so refreshing to hear that all these individuals from different times, different places from around the world kind of came to the same conclusion that 2027 to 2029 there's something major will happen, whether it's, as you mentioned, right, whether it's a market correction, inflation, a currency reset. And I know a lot of people are expecting 2030 to be this new world that we are entering, probably because of this reset. And the great Klaus Schwab, he always talks about the great reset. So it's something that has been talked about, and I think you guys are absolutely on the right track. And for those watching, the six cycles, if you want to go dive deeper into it, are the company cycles, market cycles, business cycles, economic cycles, technology cycles, and country cycles. So audience, definitely check it out, because not only is it what's actually happening right now, but I mean, if you look at the geopolitics in the world right now, things are all over the place. Things are confusing, things are complex, and there will be a reset coming. And I definitely agree with you on that, Eli. And so, how did you discover that these six frameworks pointed to this window? Did you just like start reading, learning, or did you get approached by someone and said, "Hey, this is what's happening"? How did you even get down this rabbit hole?
Yeah, that's such a great question. That is sort of the magic, in my opinion, of where we are within the technology cycle. It really does, and this is, such an overly used, overly applied term, but I don't think it can be overstated enough of what AI actually means to the future of humanity. How we discovered it was we didn't. Kronos, our AI, did. He did that in a way that was both inductive in its process, taking the operating system that we have implemented on our side in terms of how we've constructed Kronos, and what he was able to do with that in terms of the reasoning logic is come up with these six cycles to identify and model the world. And what we discovered from that was that with respect to these six cycles and the window that creates is there is a specific math that has to be followed through with respect to the outcome of said six cycles. And that math basically looks like about four different scenarios. So what Kronos was able to do is calculate the probabilities of said scenarios and the scenarios themselves. So let me just sort of walk you through what those scenarios might look like. Kronos basically says that scenario number one is that we go through a controlled deleveraging. That means that we are going through this cycle with respect to coordination from governments, coordination from individuals within those said governments, and that we go through what Ray Dalio calls a beautiful deleveraging. That scenario lends us to a market that's down roughly 15 to 20% is what Kronos has calculated. The next scenario is that we go through a reactive deleveraging, in which case we are not coordinating in ways that allow us to make the necessary adjustments with respect to what needs to be done to reorganize the debt, but instead we are reacting to largely what's happening with interest rates and markets with respect to globalized debt refinancing needs. And what that looks like is a downturn of about 40%. So that's kind of a reactionary deleveraging, in which case we think that's probably the most likely scenario that we get something along those lines. But essentially, that means that we go through somewhat of a 2008 type of moment with respect to downturns in the market. The difference being that as opposed to real estate being the catalyst and the primary cause of said downturn, the primary catalyst and cause is the government itself and the U.S. debt that's been accumulated. And so the normal flight to safety that would necessarily occur with respect to where to hide during some kind of downturn actually ends up being the source of the problem. So that's the problem with that form of deleveraging. Option number three would be some type of interest rate shock, in which case there is a treasury auction. We're trying to refinance said debt, and we get a big spike in interest rates. When Kronos did the math on this one, Kronos pointed to a historical analog of 1981. So if you look back at what happened in 81 with respect to Paul Volcker, some of the shocks that took place then and what happened with markets, you saw downturns at times that exceeded that 40% range with respect to what was possible. Now we're in a much more globalized environment, much more interconnected. So the math on that looks to be about a 50 to 60% downturn in that kind of scenario. And then the last one is a collapse of the currency. And you mentioned this earlier that the dollar is right now the U.S. The world's reserve currency. The U.S. dollar is the world reserve currency, and that gives us a lot of power around the world that allows us to borrow at interest rates that others cannot borrow at, and that really is a big fuel and a big engine for growth. However, if that were to be undermined in terms of that US dollar dominance, and we were to go through some type of currency collapse, you're talking about downturns in the neighborhood of 80%. The analog that Kronos gives us for that is the Weimar Republic in Germany in 1921. And you saw kind of what happened with that. You can go look up, some of the deleveraging cycles and kind of what took place and ensued post that for Germany, and a lot of some of the same type of mechanisms that you could sort of see if a world reserve currency scenario were to play out. The difference being for the U.S., of course, is that at the time, Germany was not the world's reserve currency. The UK was, and the sterling, the pound was the sterling pound was the world's reserve currency. And so, if we were to go through that kind of cycle as the world's reserve currency, you would imagine things would be even that much more chaotic and that much more problematic. And again, kind of the need to really spell out these four scenarios in order to not say, we're calling for these to be the case imminently, but saying these are the risks that are on the table that we want to make sure that investors are prepared for.
As you were talking about these events or possible scenarios, it is scary, right? Looking at what's even currently happening right now with the markets and the currency, and people are already thinking, oh, this is the bottom. But there's more to come, and it is very scary. And I do know a lot about what Germany was going through in the 20s, where I mean inflation was, I think, in the hundreds of percents at that point. Homelessness, unemployment was through the roof. And that obviously changed, especially when World War II came about. But do you think this shift in alignment can maybe come sooner or maybe go later? Like, is this window kind of a fixed window, or can something happen before that? Because I know a lot of people are scared. They're pulling their money out now. We have geopolitics. We have a new Fed chair coming in. A lot of things are happening. It's just kind of like a spider web of problems and issues. What are your thoughts on this window? Is it a fixed window, or is there a possibility it can happen after 2029, or maybe even before 2027, or maybe are we kind of maybe in it already?
Yeah, listen, I think that's a great way of thinking about the problem. So let's talk about a little bit about the underlying math of what's driving this. So, can we avoid this, or does the window come sooner or later? Let's talk about what's driving said window. So, what we're looking at right now, in terms of the debt problem, is about a $15 trillion debt roll that's going to come due. What we're calling in our piece, when clocks align, a $15 trillion debt wall. That comes due in between 2027 and 2028. And then you have about 61% of the overall debt. Right now, debt, it really sits around 40 trillion or so. Our economy is at around 30 trillion. So you get to 125% debt to GDP. That 60% has to roll before 2028 fiscal year ends. And so that is why that window exists, because that debt has to be dealt with. And that's just a mathematical fact. Now, how is that debt dealt with? It is an open-ended question. The challenge with it is that if we look at sort of some of the current proposals that are being thrown out there, they're talking about making the short-term debt, I'm sorry, the long-term debt that we have into short-term debt. And so you have something that develops called roll risk. And what that means is that we're taking debt that, for to a large degree, with an interest rate of call it 0% or so, with very, very low, nominal low interest rate attached to said debt. Um, if we have to roll that into shorter term debt, into shorter term financing, now all of a sudden, yes, you do deal with the problem of the higher term interest rates and the higher term borrowing costs, but now you deal with the shock problem. And now we move into the camp of deleveraging option number three, in which case, if 61% of the debt is in short term, is being financed on a short term basis, if we get any kind of interest rate shock in between that time, now all of a sudden you've turned a long term problem into an acute short term problem. And so the real risk here is that, how that 61% rollover, in terms of debt, in terms of the broader overall debt is concerned, is dealt with, is going to dictate how that deleveraging and which one of those phases actually occurs. So, that window is something that cannot be moved around. The big question again is, how is the debt dealt with within that window?
Thank you for explaining the reason for that window, because I personally did not know that 2028 there was going to be a massive, I guess, callback of debt, or a callback of the issues that we're currently going through. And so what can we actually, well, I guess not the average person, or maybe the average person, but what can be done to, I guess, if it's inevitable, how can we mitigate the damage when that window approaches?
Yeah. So before I jump into that and how do we mitigate the damage, I also want to point out that at the same time, the big question becomes, well, can we grow our way out of this? Is AI going to be enough? And to me, if you look at the numbers and you look at what needs to be done in order to grow our way out of said debt, you're looking at an economy that would have to grow at about 7%. Now with a developed country, that's a pretty tall order. Structurally, we sort of max out at about 4 to 5%. That's an economy that's booming. That's AI taking off. That's productivity rates going through the roof. That's 4 to 5%. To get to 7%, you'd have to be talking about 1990s China. So
That's
the
when
so
everything has to be working perfectly.
everything has to be working perfectly. So then the question becomes, okay, why wouldn't I just sit this out and wait for the crash to occur and then come back in? The problem with it is that the AI boom is real, the AI revolution is real. And so the technology cycle on the other side of this, we also don't know when that's going to exactly come. In terms of that 7 to 8% growth, you have like Nouriel Roubini, Dr. Doom, who's not known as a guy who's seen as being historically optimistic, called the 2008 crash, puts estimates on the AI boom of 6%, 7% growth, but that doesn't come until till 2040. Then you look at 2050, he's putting about 10% GDP growth resulting from the AI boom. You can't miss out on that growth. And so, as you know, the market is a discounting mechanism. It's going to start pricing that in early, that level of growth. So we're sitting at somewhat of a juxtaposed tension and challenge within the market of, we've got this big debt problem that is imminent, that has to be dealt with. At the same time, we have a technology revolution that will make the last industrial revolution that we went through in the 20s look like it was just a drop in the bucket. So you can't miss out on these markets, and you also can't afford to not deal with the volatility. Now, to get to your question, how do you deal with said volatility? Well, the challenge becomes if you're looking at a 60/40 portfolio, a passive investing portfolio, if you look at just kind of the simplistic setup of a traditional portfolio, you've got your S&P 500 ETF and you have your bond ETFs. The issue with it is that those two sides of the portfolio likely go down together. And we've seen this play out in 2022. Your fixed income, particularly your treasury market, particularly your long duration, like your TLT ETF, was down in the neighborhoods of 30+%, while the S&P 500 was down 18%. And so you're dealing with a portfolio, if you're at a 60/40, of being down well over 20 to 25%. If you are 5, 6 years out, 10 years out, even from retirement, all of a sudden that's a big hit for you. And depending on which one of these deleveraging cycles we go through, depending on the duration and how long everything lasts, until we get to the other side of the technology cycle, it could be a pretty rough situation to not be in a position to know how to navigate this type of new world environment. And so, long story short, we built Kronos to deal with this environment because we knew that the structural capacity for any one human to hold 6 different cycles, to analyze 250 years of information with respect to said cycles, and to compress that into 1 week price targets was beyond the rationale of even 100 or the rational capabilities and analytical capabilities of even 100 analysts. And so Kronos really is set up to both inform and enable us internally, as well as for individuals that are just investors, such as the investors on your show, to be able to go and make well-informed cycle-based decisions in order to protect themselves, protect their portfolios in a very untraditional environment.
That's actually when you're talking about the growth. Now looking back on it, I saw a report the other day where China predicts to only have a 4 to 5% growth moving forward. So, I mean, if China's only having 4 to 5, then that could only mean that us over here on the other side of the ocean probably might have less than 2% or even less than 1%. And I think that 7%, 8% growth needed to I guess boom and mitigate whatever's coming to us is going to be a long, far-fetched, I guess, goal because we're not doing too well right now, as you just discussed. And so to your last point, when if someone was going to start investing, say someone is 18, 19, 20 years old, they just saw this interview, they're like, oh no, okay, something is happening between 27 and 29. How should they start allocating their portfolio? What's assets are vulnerable? What assets will thrive? It could be your personal or professional opinion, but what should someone be doing right now to kind of prepare for what's to come?
Yeah, I think that's the right way to look at it. I mean, Jacob, if I'm 18 years old, how am I approaching this market with what I know after being in this industry for almost 20 years? How I would approach this market is first and foremost, educate yourself. Educate before you act. Because we are in an environment where the cost of not being educated as it relates to the cycles that we're in is just too high. And that cost will be something that'll accelerate and increase exponentially as we go through these different phases. Because again, what we're dealing with is a tension. The tension is how do we deal with a debt problem that has to be dealt with and historically is dealt with in one of those four ways. With the boom of being likely the last industrial revolution that humans are solely driving. And that kind of productivity boom, what that means for the economy on the upside. So if I'm 18 years old, the first thing that I'm doing is I'm trying to understand these cycles. I'm trying to understand the moment that I'm in, and what likely comes next. One of the reasons why we built Kronos is for investors to be able to do that, to ask those types of questions to Kronos and say, hey, I'm 18 years old. I'm looking at this type of setup for myself, for my family, whatever the case might be. What type of portfolio do you recommend that I set up for myself? What are the considerations that I should have in this cycle? Because the second thing is that you really want to be in a position to, unlike what we have been in the past, where you could just sort of set it and forget it with respect to a 60/40 allocation or an 80/20 allocation, which if we were dealing with this 10 to 20 years ago, you could set up an 80/20 allocation as an 18-year-old and let that cycle run its course, and you come to the other side and you've got a nice portfolio by the time you're ready to retire. Those days are gone. With the time period that we're in right now is that these cycles are going to get more and more volatile, offering more and more opportunity, but also offering more and more risk. And the way to navigate them is really to take a cycle-based view of what type of portfolio do I need to set up right now for this particular environment. When the environment changes, you must adapt that portfolio. And we're having to do that for our investors. We're having to do that with our time ETF internally. And really, all investors are going to be faced with this challenge of how do you balance out risk of a chaotic environment that we have not seen in 80 years, with the opportunity of the upside that we haven't seen ever.
That is very well put because I think the old traditional way of investing of, bonds, treasuries, S&P or NASDAQ kind of index funds is kind of over, right? A lot of new ETFs are all about the option plays, the income plays. Everything is wrapped in an ETF these days. And I think a lot of people are in that learning phase again because the old traditional system is not failing, but it's not as, I guess, reliable, exciting, or even more profitable with the gains. And so let's take a pivot here and talk more about this amazing AI Kronos. However, before we do, what are your thoughts on cryptocurrency, especially when it comes to these cycles? Do you think crypto has a role or place in these cycles, or is cryptocurrency might be one of those asset classes that actually gets sidelined or maybe even wiped out because of this?
Yeah, we think a lot about crypto, Bitcoin specifically, but the crypto space more broadly. And we have mixed feelings on it. Generally, we this is clockwise point of view is that crypto is a space right now that is being adopted by institutions. Obviously BlackRock is sort of the leader in this space. It's getting more and more adoption amongst registered investment advisory firms. There's sort of a loose recommendation of between 2 to 3% over an overall portfolio should be exposed to crypto. But we like to take a step back and ask, what is cryptocurrency? What is this? What is the function of this asset class? Is it an asset class? And really take a first principles view of this of crypto in and of itself before we say what to actually do about it. And so the question for us is cryptocurrency money? We have to then take a step back from there and say, what is money, right? Money, three definitions: a storehold of value, a unit of exchange, and an accounting system, and a means for account. And really, cryptocurrency checks off all of those boxes except for the storehold of value, right? And really what that means is that cryptocurrency right now, if you wanted to convert that into something that you could actually purchase something with, you're talking about something that is extremely volatile as an asset class. So does the question becomes, does that element of cryptocurrency get resolved? Does Bitcoin get to a point where it does amass a storehold of value? I think that's largely predicated on mass adoption. But I'm going to say something a little bit controversial. I don't actually think it's the mass adoption of humans, albeit that will ultimately be the long-term case if, in fact, cryptocurrency and Bitcoin does actually become codified as money in a permanent sense. But I think that cryptocurrency and Bitcoin specifically is more so money for technology, more so money for AI. And the reason for that is because you need a high enough volume of transactions in order for the AI that you need a high enough volume of transactions for the AI to get to a point where it makes sense for the AI to use this as a means of transaction, as a means to exchange products and services amongst other AIs. So you need that mass adoption to take place for that to happen. But the interesting thing about cryptocurrency, Bitcoin specifically for me, is that AI ends up being one of the few spots where cryptocurrency and Bitcoin specifically is something where AI can actually take this and make it something where no other type of money can perform at this level. And so to me, crypto ends up being a bet on the future, a bet on an economy that's largely driven by other non-carbon based, primarily silicon based forms of intelligence.
That's actually very interesting that you said that because I do agree with that. I think when it comes to Bitcoin specific, I'm an Ethereum guy, but when it comes to Bitcoin specifically, I don't think there will be a lot of human cases for it, but there will definitely be a lot of AI agent uses case for it. I think I read a report the other week where it said that the blockchain pretty much will be the ecosystem of AI agents. Yes, humans can interact and do things on it, but AI agents will primarily be using it as their vehicle to interact with each other, communicate with each other, and pretty much live on their own ecosystem. So it's actually so cool that you actually said that, because not many people are talking about that. You hear some whispers, but not all the time. So I think personally, crypto is going to be a bet on the future. We don't know where it's really going to go, but I I believe in it. I believe it is going to be a long-term asset class. I just hope the quantum chip doesn't ruin it for us. But whatever happens, I think crypto is here to stay. So now let's get into the awesome AI Kronos that you guys have built. So my definition of Kronos, from because I have been playing around with it the past few days, is that it is to empower investors with a clear framework for interpreting the six cycles that we talked about earlier in global markets, and it pretty much combines AI analytics and rule-based process. So the goal is not to teach what is happening, but also explaining and detailing why it's happening, so you can build a very knowledgeable portfolio. But of course, you as the person that built it, your team built it, can you walk us through how Kronos works? What was the inspiration behind creating this AI?
Yeah, I think that's well said. Jacob, what we wanted to do is put a portfolio manager in everyone's pocket. And that's what we tried to build Kronos for. The reason why is because I think portfolios management is going to become a much, much bigger part of everyone's everyday life, as we move to a world where humans do less and less of the work within an economy. And we're already sort of starting to see that trend. I mean, if you look generationally, and this sort of comes full circle to where we started, participation in the markets is something that has long been an issue and still is an issue, for Americans and for certain communities that have not had the necessary access to information, and the tools in order to implement said information. And if you think about what that means now, roughly, I think about primarily the vast majority of people are investing in the stock market through their 401k. But if you think about the number of people and the number of Americans that are not investing, and the ones that are not putting money towards how do we participate in these technology cycles that we speak to, what that really means is that we're talking about a wealth disparity problem that's already bad that gets worse. And we our my portfolio managers and our analysts, they look at what we're likely to see in terms of sort of the long-term effects of what AI is going to do. And the realization is that we're going to have much more of a symbiosis between AI and humans. But the likelihood is that agents will basically operate on the behalf of humans, which will then come back and have conversations with their sort of attached person, if you will. And you'll have much more of like a employer-employee relationship with your AI. And really what that means is that you're going to have situations where more and more of the economy is run by non-human operatives. And how does that capital then flow back to humans at a base level, such that humans are able to sort of effectuate and implement all the gains that we're going to achieve as a result of this technology cycle. And really, what that means is that it comes back to your portfolio and the portfolio wealth that it's able to generate. So the sort of loose vision of the future, Jacob, is that we're in a situation where more and more of your portfolio will almost be a mechanism for some type of universal basic income, and almost kind of how your Norwegian sovereign fund works at scale, where they're investing in a lot of technology, a lot of backers of Silicon Valley. They then take that wealth that's accumulated and they reissue dividends to their citizenship. Some model like that for AI and for portfolios as a whole, we think will be the future. And so, what Kronos was built for is to do two things. One is giving individual investors a means to navigate said future, to have an understanding of where we are within the cycles, to have an understanding of where their portfolio is in the cycle, how to best position for that. But also as a mechanism to say, how do we then translate your portfolio into a source of income and a source of wealth that can support you and your family? And so, as you use Kronos and as your users use Kronos, what they'll experience is kind of Kronos in three different frames. One is what does the environment look like right now? What are these cycles pointing to? What does the clock look like, if you will? The second is how does that impact my portfolio? How do I test my portfolio against these cycles? But thirdly, it's how does then that translate into my own personal situation? How does that impact my goals? How does that impact me from an income perspective, such that as we go through some of these rockier times, as we go through some more of this volatility, I'm still able to take my lifestyle and support my family, have a lifestyle that is supportive of me, and actually experience a lot of the gains that we're going to experience, we think, in many ways pulled forward by the market. Whereas if we get to a point where, we're looking at some form of what we think is a necessary level of universal basic income for the masses, how do we make sure that we get more and more investors access, more and more investors participating so that they can formulate their own universal basic income for them and their families?
You know, that was actually so like it's like a revelation because universal basic income has been thrown around the past few years, but nobody really took it seriously until you started seeing in action, not only in various countries, but I'm in Canada here, and they're already trying it out with some cities, and they're saying it's successful. So just to kind of stay on that UBI, do you think it will replace jobs and that's the reason we go on it, or do you think that while we're working it's just an extra benefit? Because a lot of my viewers, they love fixed income, they invest heavily into dividend paying, distribution paying ETFs and assets. But what is your thoughts on UBI? I hear so many people saying no way, we're going into this path of, communism, socialism, that's not the good way. Then you have the other way saying, you know what, it can be an extra income, especially if your country is doing amazing with, AI gaining the profits. What are your thoughts on that?
Yeah, listen, I was also when I first heard about universal basic income, I said, well, this sounds a lot like socialism and redistribution of wealth, and we kind of know some of the challenges with that, in that it has the tendency to suppress growth. And for me, you have kind of two sides of the equation. You've got your capitalism side, which says, let's grow the pie. And hopefully we have a bigger pie that gets distributed well and that feeds more and more people. The other side is let's carve the pie up into as many slices as possible to make sure that everybody gets a bite. And so what I think that ultimately this is all going is that we're going to grow this economy no matter what, to a point where we need a mechanism for making sure that there is sort of an in between of growth, and how do we then distribute that so that people in many ways that are not investing necessarily, and experiencing at the stock market level can also have a participation in said growth. And so to me, universal basic income ends up being that mechanism. I remember when this was, I believe, 2016. Andrew Yang, a presidential candidate here in the U.S., was
Yep, I
running,
remember him.
and you remember Andrew Yang, and he was that was his big push, was universal basic income, and really reading a lot of the material that he put out really changed my mind on it. You look back at history, and everybody from Milton Friedman to Martin Luther King were proponents of universal basic income. And if we think about what it actually means, universal basic income, in terms of that distribution problem, I think there's two ways to do it, and I think there's a way that is pro growth and pro capitalism, and then there's a way that's not pro growth and not pro capitalism, and the way that's pro growth and leads us to a position where universal basic income ends up being a good thing, a source of how do we make sure that everybody is well taken care of, is how are we actually funding it? How are we funding universal basic income? If it's done by just raising taxes, then to me it's very anti-growth. We don't want that. If it's done by participating in the investing of the growth and then taking some of that investing appreciation and redistributing that to people, I think that is something that we want. And to me, that's the clear distinction that we want to draw in terms of UBI itself and the administration of it is how are we funding it? And that's why I go to the Norwegian model, because again, that I think is the best model that we can look to for the source of universal basic income.
That is the biggest question. How are we going to fund it? And so I think, I'm sure every country, especially America and Canada, we have a lot of, homelessness or unhoused. I think that's the proper term. We have high unemployment. We have child poverty. All these issues can definitely be helped, or at least, better support through UBI. But the main question is always, are you going to raise taxes? What are we going to cut to fund this? I think it's just all about, great government decision making, great government investing to obviously grow the country's finances and so on to distribute it, right? I think Trump wanted to distribute the tariffs to the American people, which I think is great, but I don't know if it's going to actually happen still, because I think that money needs to be directed to other places now. But I think that is the main question. And I hope they don't raise our taxes, because we're paying 40% out here in Canada. So,
Yeah.
that's wild. So just to go a little bit back to Kronos, last question on Kronos. How often should someone run their portfolios through the Kronos AI? And does Kronos recommend changes, or does it just signal things that are going wrong and kind of give you a summary? Because I know when you put in any type of stock or predictions into ChatGPT or Gronk, it says, we can't predict anything, or we can't really help you with your portfolio. Does Kronos actually recommend, hey, you should do it this way based on what's happening? Or is it more just, giving you signals, okay, this is not the right way. Here's a breakdown of why.
Yeah. Listen, Kronos does not give recommendations on portfolios. It's not giving advice specific to say, here's how you should invest your money. What Kronos does is Kronos tries to identify the market that we're in, the cycle that we're in, and the environment that we're in. It gives you that cycle and that environment so that you can make well-informed decisions about how to position your portfolio to best align with that market. The analogy that I like to use is, a clock versus a sundial, right? So for clock nerds, this will resonate. A clock is basically off by about 15 minutes, plus or minus, at any given point. And the reason why is because it takes the average. It doesn't factor in where you're positioned relative to the sun. It's giving you an average time. Well, that's kind of like what a passive ETF is doing. It's giving you an average. But the issue with it is it acts as though winter time and summertime are the same season. A sundial does not. So if you wanted to grow crop yields as an example, you would want to use a sundial over a clock. Because what a sundial is doing is saying, how am I positioned with respect to where the sun is? And how do I best align to that, factoring in the season that we're in? And so if we're going through the winter, you're going to want to have a very different portfolio versus if we're in the summertime or the spring. And so what Kronos is trying to do is tell you which season that we're in. And then it is up to the individual investor to say, how do I best align with said season? And for that, we offer a means to talk with human advisors that can actually sit down with you and take the analysis that Kronos has provided and give you their opinion on how to best align with said cycle, how to best maneuver your portfolio so that you're in a position where the risks that we're seeing out in the market, the prevailing risks that the cycle identifies, are being accounted for with respect to your portfolio. And so the process is really simple. It's first go and test your portfolio, Clockwise Capital /Kronos. That will give you your first initial portfolio analysis. You asked how often you should do it. You should be doing that. What we do is about once a week. We want to see how the portfolio has shifted with respect to the market environment and how the market environment has shifted with respect to the cycles. And so we test that out about once a week in order to come up with how we want to be positioned with respect to our portfolio. But the second thing is that then you're going to see uh, what that portfolio analysis is telling you. What are some of the risks in your portfolio? And you want to be really cognizant about making sure that you're not making old world assumptions, that you're factoring in where we are right now within said cycle, and not making the assumption that the portfolio that you had set up even a week ago is the right portfolio for you now. And then the third thing is if you feel like you can do this on your own, you feel like you're a self-directed investor, then make sure that you're at least talking to someone to get a second opinion as to what that looks like, what that alignment looks like, whether it's an advisor, whether it is a market professional that you're comfortable with, that you feel like is an expert at making sure that all the risks are being accounted for, and that you're setting your portfolio up for success.
I love that because, especially right now in these confusing times, people don't know what to do, who to speak with. And I think Kronos, an AI that is pretty much dedicated to investing, portfolio building, and looking towards the future in these different cycles, I think this is way more highly beneficial than, ChatGPT, which can talk about an array of topics or any pretty much anything and not really focus on portfolio building. So audience, I will definitely have Kronos and Clockwise Capital's information in the description box. So please check them out because I've been playing around with it the past few days, and honestly, it is very, very enlightening. And by putting your portfolio into Kronos once a week, once every 2 weeks, once a month, you are staying ahead of what is happening because as humans, we have limitations. I haven't seen limitations yet. So Eli, on this channel, we do have a little small segment where we ask out of the box questions. Are you up for it?
Let's do it.
All right. If Clockwise Capital was a personality or a person, what type of personality would it have?
Oh gosh. If Clockwise Capital was a person with a personality, what type of personality would it have? Well, needless to say, we're very analytical. If you think about the different personality sets, your former Myers-Briggs, and your different four quadrants, I look at Kronos as being sort of a combination of analytical in the sense of trying to give you the facts, the data, compressing information in ways that humans can't, but also the empathy side, and making sure that it's doing it in a way that adjusts for where is this person at within their own personal life cycle. Is this a person that's just starting out, that's 18 years old, that has very little background in dealing with markets? Okay, Kronos can then adapt and adjust to making sure that the message that is very analytical is being adjusted in an empathetic way so that that person is receiving it best. On the other side, if it is a sophisticated investor, someone that has a deep background, someone that's been investing for 30, 40, 50 years, Kronos can also speak at a very, very intense very granular level. Discussing the analytics, what's the beta of your portfolio? How much risk are you taking on? What's the standard deviation, the upside downside capture that we estimate within the portfolio based on our own internal analytics and some of the same processes that we're running internally. So in my opinion, to answer that question, Kronos is a combination of analytical and empathetic.
I love that. I love that because you gotta have that awesome balance, right, in life. Second question, what is the most random app that you have on your phone or your device that you downloaded? Some people have a meditation app, some people have a sunset app. What's like the most random app that you have?
The most random app, I don't know if I have any random. I try not to do it randomly. But the app that I would say uh, is most left field, if you will, most divergent. Um, you know, there is a I'm a big lover of fishing. Anybody that knows
Nice.
me knows that I do a lot of fishing. I love bass fishing. I love some deep sea fishing. As far as fishing is concerned, I have an app called FishBrain. And FishBrain will do everything from look at moon cycles to
Oh,
temperature and water. What is the best bait to use for any particular body of water? It'll let you analyze the geography of a region, the right temperature and time to fish. So it tries to use a composition of different analytics, different frameworks, and sort of somewhat of what Kronos is doing but for fish. And so I'd say FishBrain is probably the most random app.
that is actually so cool. So you're looking at the geography, the lunar, pretty much even the bait that's used. That's actually so cool, actually. And last question. If you were not
I'm still a struggling fisherman though, so
well, I mean, if you can catch your own food, you're already, achieved higher than most people in this world.
Amen, amen.
And the last question, if you were not in finance, investing, in any of that world, what unrelated career would you have gone into?
Oh wow. You know, I- for me, I've always been a huge fan of anthropology. I've always, for me, really, the stock market is really an extension of my love for anthropology and human history, how humans have been able to adapt and solve problems at scale. To me, it's like the stock market is a human prediction machine, and in the short term, that human prediction machine is basically a psychological indicator of where are we from the perspective of fear and greed, and gets into the underlying human elements of how do humans manifest fear and greed, and we end up making these same mistakes over and over and over again. And you see that throughout the anthropological cycle. And if you read, whether it's Yuval Noah Harari's *Sapiens*, Robert Sapolsky's *Determined*, David Buss's *The Evolution of Evolutionary Psychology*, you kind of see these same recurring patterns happening over and over and over again. And it's fascinating to see that played out in the short term in markets. In the long term, the market appears to be somewhat determined. And you see that by way of humans being somewhat determined, given a large enough scale. And where I started with this in 2017 was really the sort of intersectionality of reading Jeff West's book On Scale and the understanding of humans, weather patterns, trees, any complex adaptive system basically follows very similar patterns. You look at like mammals, and it's no coincidence that every mammal gets about 1 billion heartbeats. And so, to me, the structure of these complex adaptive systems with respect to scale, and then the combination of that and what I was able to read in the very early paper that ended up creating large language models, attention is all we need. Reading the combination of those two in 2017 is sort of what made me start Clockwise Capital, and understanding that human nature from an anthropological perspective, relatively unchanged, and you combine that with where technology is going, and you sort of kind of start to see that the world is going to be very different over the next 10 years. And how do we prepare for that world? How do we bring more and more people into the investing fold to be able to take advantage of that world? And to me, the tension between being prepared for the short term of what we're likely to go through in terms of a certain level of chaos that we're already experiencing to a large degree, with the prospect of the long term of where technology is likely to lead us, is a human story. And so, to me, the fascinating area that I would love to be into, if I weren't doing what I'm doing now, which I think is in many ways the application layer of anthropology. But if I weren't doing that, I'd just purely be studying anthropology.
I absolutely love that because, the past really does repeat. Everything is a cycle, everything is a pattern. And, investing, finance, the market, and of course, the past, anthropology. I love it because I'm a history major. Anthropology is just, down on that path as mine. So, we're both history nerds, I guess. And
Yeah,
it's
yeah.
amazing. So Eli, you have given us some amazing wisdom, some amazing gems today. And honestly, it's definitely one of my most favorite interviews because it was so one of a kind. We're looking at the future, we're looking at what's happening right now. And I think a lot of my audience members are definitely going to be taking so much of what we discussed today and putting it into their portfolio, even using it into their own personal life, and even what they see out there in the markets. So, audience members, please make sure that you check the description box. I will have Clockwise Capital and Kronos links in the description box. And Eli, before we end this interview, is there any piece of advice, anything you want to throw out there into the digital world?
Yeah, we are getting ready to launch our book, an ebook that lays out, it has When Clocks Align baked into it. But we really want to lay out the transition that we expect. What do the next 10 years look like? And how do we prepare for increased volatility and increased opportunity? And what I really tried to do is take the conversations that we're having on an ongoing daily basis and really embed them into a book to answer a lot of the pertinent questions that keep coming up over and over again for us, which is primarily how do we navigate the next 10 years when we know that it'll be very different from any other point in time in history, but more or less because of the same reasons. And so, every audience member that downloads and test their portfolio through Kronos will get a free copy of that ebook. And so, Jacob, I'm going to send you a discount code, a link code, so you can provide that to your audience members.
Oh,
But
that'll be
listen,
awesome. Thank you so
yeah,
much.
absolutely. And, thank you for what you do and the knowledge and information that you bring to investors, and the platform that you create for individuals such as ourselves.
No, I appreciate, people like you who have so much knowledge, and sometimes all you need is a platform to bring that knowledge to the masses, because I know in this day and age with everything being on TikTok, shorts, you can't really actually explain your vision or explain your goals or explain what your thoughts are. And so I'm happy to always host you, Eli. Audience, this is not the only time we're going to have Eli on the channel because we really want to know what's going on with these cycles, especially with 2027 just around the corner. I mean, where did 2026 go? It's almost what, a third in. So Eli, we would love to have you back anytime, especially when your ebook drops. We would love to have you on again. And thank you again for the code for my audience members. Audience, you know, I always bring you the best guests with the best information, not only to build your portfolio and maximize your gains, but also just food for thought, right? Right now, 2026 got off with a bang. We are in so much geopolitics. We are in so much market, uncertainty. And so stay tuned to the channel. Make sure you like and you subscribe, because this is the only place where you can get raw, unfiltered truth when it comes to the world and the markets. So, Eli, thank you again for being here with me today. And audience, stay ranting.